Welcome everybody. My name is John Broussard and I am going to go over working capital management issues or issues associated with working capital management in this section and this segment of the video series. Specifically, what we're going to cover are really some basic concepts associated with the whole idea behind what is working capital. And I think one of the things to remember, there's lots of different ways to remember working capital. There's lots of different ways to kind of think about what is working capital, but the specific definition, is nothing other than what working capital is current assets minus current liabilities, right? So when we think about that, what are the issues, what are the items that we need to focus on whenever we are, whenever we're trying to manage the issues associated with current assets and we're trying to manage the issues associated with current liabilities? I like to think of it that way because of the standpoint is that it really is all about issues associated with liquidity being created and I would say being generated, if you want to think of it, and the liquidity is being taken from the firm and its operations. And that's the reason why the title of it's Working Capital Management. So from that perspective, let me go through just one little idea I want you to remember, and hopefully I can do this right. Yeah, okay, I think I can get this right. My pen, the tools there come about. There's a couple of things that I want you to think about whenever we talk about working capital management. Okay, the first one is associated with the standpoint is you should always be thinking when you think about working capital management, you should think of these two ideas, and these two ideas should always be in the back of your mind whenever you're thinking about working capital management. The first one is liquidity. Right? And when we talk about liquidity, we mean access to, really the easiest way to think about liquidity is just access to cash, right? Or some kind of way that we're going to take cash, turn it into an operating asset to generate cash so that we can pay our bills and we can supply funds to our suppliers of capital, something like that. Just think of that. And then the second piece, which is usually connected with the whole issue of liquidity, is a short-term horizon. Okay? So, and you say to yourself, well, John, you've already said that because when you said working capital is nothing other than current assets minus current liabilities, it really is a short term, right? That's what we're talking about. We're talking about short term. We're not talking about long term. We're talking about short term. So the idea, if you can, throughout these slides here, these 15 or 16 slides that we're going to go through, if you can kind of keep in the back of your mind issues associated with just general concepts of liquidity in a short time horizon. And when we talk about from an accounting perspective, the difference between short term and long term is what kind of that demarcation period is about a year, right? So that's kind of the idea. So with that in mind, let's go ahead and talk about the first concept, the issue associated with sources of liquidity. Where can we get liquidity? All right, where can we get liquidity? Well, there's a couple of places and a couple of sources. There's primary and secondary sources. All right. When I think about primary sources, I like to think of these being more short-term in nature, and in the secondary sources, even though we can get liquidity from the secondary sources, it's going to be possibly a significant change in the firm and the way that it looks. So it's kind of like getting short-term gain for a possible long-term pain. And what I mean by that is we can go ahead and renegotiate debt, meaning that, or the idea is hopefully that we will get or will have to pay a lower interest rate, which means that we'll have to pay less interest expense, which means we can keep more of our cash, and that's fine. Okay, that's fine, and that's always a good thing to do, right? I mean, it's always it's always better to pay less, right? Receive more and pay less, right? So that's okay. But the idea here is that that's going to change the capital structure, or really could change the interactions of the capital structure of the overall firm. All right. we could liquidate some assets, right? Now, what does that mean? That just means selling assets, right? And so we can raise some cash by selling assets. But if we raise cash by selling assets, what does that mean? Well, the assets used to generate, well, hopefully the assets were generating some kind of cash because of the operations. But we don't have those anymore, right? So we've gotten rid of them. We've sold them, right? We've sold them to generate cash, but we no longer have access to them to generate more cash into the future. So that's kind of that's the reason why I call it a short-term gain for possible long-term pain. It's not always going to be negative because many times firms might have assets on their books that really are not generating the amount of cash that they should be, or really are not connected to the long-term focus, or really the focus of the firm anymore. It's just they're just on the books, and they're generating something. There was kind of a legacy issue that we thought that we really wanted to keep, and really now that we kind of refocus our energy, we're not going to be focusing on them anymore. So that's the idea. And then, of course, as always, the idea of bankruptcy, right? We just go ahead and stop all payments going out to try and renegotiate the structure of those payments so that we can maybe stay alive as an operating entity. Well, these secondary sources, right? These secondary sources are a little bit more, I would say, more involved than the primary sources. And years ago, whenever we talked about liquidity, I mean, the definition of liquidity has kind of changed over time, right? It's kind of changed over time. It was more of you could kind of think of the issue associated with liquidity as being kind of an asset liquidity source and a liability liquidity source, and that's really what these 2 points are, right? And then we're gonna stay with those. Okay, we're gonna stay with those kind of, I would say, traditional definitions of liquidity. Okay, which are what? Cash equivalents, collections, i.e., what you're getting, what you collect from your accounts receivable. Investment income, and you have extra cash that you don't need for a certain time period, and you essentially do what with it? You invest it, right? And you invest it, and you have some income from that cash. It's not necessarily being invested in an operating asset, but it's being invested in a very safe and secure financial instrument, and it can generate a little bit of income while it sits there. Then on the liability side, or really what we owe side. So this is what we own side, and then this is what we owe side, right? We've got trade credit. Well, trade credit is what? That's accounts payable, really. I mean, that's all about you and your suppliers, having some kind of agreement that you need some kind of supplies, some materials, or something like that, and you receive them, and you're going to pay them back later. So that's kind of the idea. Bank lines of credit are, a lot of people kind of think about, I like this, okay, a lot of people think that bank lines of credit, they think of those, quote unquote, short-term access of lines essentially are very temporary. But really, if you look on the books, financial statements, I mean, you look on the books, that line of credit is always there, right? Well, the long-term debt, it will mature and then have to be replaced. But that line of credit, generally speaking, is always going to be there. So I like to think of kind of interesting, idea here is that line of credit is really a permanent source of liquidity for the firm. Now, what that means is you can have access to the funds, you can have to pay them up. I mean, you can draw them up, you have to draw them down, etc. But though it gives you access to liquidity. So really, when we talk about trade credit and bank lines of credit, we really are talking about what we owe, right? And then of course we can have these short-term investment portfolios to generate some cash, and that which I'll make a connection back to the investment income. It's not specifically what we owe. Type of situation, but it might be a little bit longer term, okay? It might be a little bit longer term, but not yet long term, okay? Not yet long term, but we might set aside for 30, 60, 90, 180 days with the standpoint that we're not going to get access. But bottom line, when you think about liquidity, okay, you should think about what? You should think about access to cash without having to take a big discount. Access to cash without taking a big discount on the value of that asset. So that's really the fundamental definition of liquidity. And when we have these primary sources, normal operations, i.e. we get cash in, we get collections, we might have some extra cash set aside, we can invest in that, we have trade credit, we have bank lines of credit, that we are using on a day-to-day basis. Secondary sources, on the other hand, really has a little bit more significant impacts on the structure of the firm. And it's not that you don't want to investigate them. It's just that it's more of a secondary aspect because it's really not a normal situation where you're going to be going into bankruptcy operations on a daily basis. Well, let me put it this way. Let's hope let's hope that's not going to be the case. All right. All right. So when we talk about liquidity, what are some of the factors that can impact or influence access to liquidity? Well, these are very general, broad statements here, right? But when you think about effectiveness of cash management, essentially, what does that mean? Yeah, does that mean how effective are we in managing the cash? So I'd like to just kind of take a little bit of a side. Here's the firm. Okay, here's the firm. All right, and we have what? This is a real simplified concept, but I'm kind of separating and disconnecting, and kind of carving out a piece of the firm. To make it look a little bit more specifically related to the working capital management idea associated with this segment of the video series. All right, so we've got dollars coming in, right? We've got cash coming in, and that comes in. From our collections, from our operations, etc. Right, and then what do? Then we have to send that cash out. We pay suppliers of some of our materials. We pay our employees. We pay whatever bills that we have to pay, right? And usually, remember now, you've got what? You've got the light bill coming up next week. You've got the employee payroll coming up next week. You got quarterly tax payment coming up next week. But the quarterly tax payment come what? Once every quarter, right? They're not there every day. So for you to be able, when we talk about effectiveness of cash management, we're really talking about what do you do with your cash when you get it in and before you send it out. And so that is really the issue associated with effectiveness. And it's, it's a spectrum that you can't necessarily say that you were ineffective. It's just that it was maybe you a little bit more effective in one time period than you were another. I'm gonna make a statement right now, and we're gonna get to it a little bit later. But it all goes back to this concept of a trade-off, right? So when you get in cash and you hold it, right, you're earning some stuff, right? But then you don't pay your bills. Well, that's you're using your cash, quote unquote. You're holding it, right? But you might be there might be some problems associated with your suppliers. They'd like to get paid. So the longer the longer you don't pay them, the more upset they might get, and the more technically, even though you might think that you're effectively managing your cash, that's really not necessarily the case. Okay, because in the short and the long term, you might get nasty looks from your suppliers. All right, centralization of collections. Really, this is all about just think of this idea here. We're not going to spend too much time on it, but just think of all the money coming into one central location, and that's kind of a lot of concepts associated with that. There's lock boxes. There's all kinds of situations where you can have all your bills sent to one particular address so that the cash comes into one particular place and can be specifically addressed a little bit more effectively and probably a little bit more efficiently. And that's the idea here is that what? No one can say, well, I sent it to your other location. Well, no, you didn't, because there was only one location that you can send the money. So that might improve and increase and enhance your access to liquidity if you have a central collection location. And then, of course, there's liquidity of short and long-term assets. Now, we've kind of touched a little bit on that, okay? Touched a little bit on that. If your short-term assets, and remember now, when we talk about liquidity here, we're really talking about what? We're talking about the ability to do what? To turn over an asset into cash without taking too much of a discount. So if you have a lot of inventory that happens to be, I don't know, what's something that's quite old, although some people would say that a lot of the old things come in are coming back, and there's lots of attention being paid on it. But I like to kind of think of like 8-track tape players and typewriters, right? I mean, yeah, there are assets there, and you can turn them into cash, but you're probably going to have to take a substantial discount of what's on your book for the inventory in order for you to get that cash. Same thing goes with long-term assets, right? If it's a long-term asset that was specifically, a piece of equipment that was specific to your operation, unless you can find another entity out there that wants that piece of equipment, you might have to take a substantial discount. So the idea is that you can turn these assets into cash, but how quickly do you need to turn them into cash? You need to sell them at a fire sale price that's going to have somewhat of a negative effect, okay? Somewhat of a negative effect. And what I mean by negative effect is, yeah, you can get some of that liquidity, all right? You can get some of that liquidity, but the problem is always going to be issue associated with how much of a discount you had to take. You can turn any asset any $1 million asset, right, into cash, right? All you need to do is take a 90% discount. Well, that's really not having, if you want to think of it, a very liquid asset if you had to take a 90% discount to turn it into cash. Yeah, sure, you got it off your books and you turn it into cash, but now it's only worth one-tenth of the value as far as cash is concerned. All right? So there are some specific, if you want to think of it, calculations that we can, metrics that we can use. We can calculate some of these metrics that are indicative of liquidity. And the two that are, I would say, probably the most referenced are the current ratio and the quick ratio. Current ratio is current assets divided by current liabilities. It just gives you an indication of what. If we really needed to get rid of if we could really liquidate our current assets to pay our current liabilities, right? What kind of ratio would we have? What proportion? No, I'm hoping you have more than one. Okay, you're hoping that your current liabilities are, possibly a little bit less than your current assets. And the idea is that what we can turn these current assets into cash to pay our current liabilities. We got a big margin, right? So if we have a current ratio of 4, wow, that means we can really turn those current assets into cash in order to be able to pay what's due upcoming real quick. All right, so that's an idea. The problem comes into play is that current assets contains inventory, and depending upon the items that you have in inventory, you might not necessarily be able to turn those over into cash without having to take a substantial discount. So the quick ratio essentially is current assets minus inventory. All right, minus inventory. Even though it's cash plus short-term securities plus receivables, it really just eliminates the issue associated with inventory. So if you were attempting to try and formulate, what kind of access to cash do you have from your current assets minus the negative impact or the possible slow changing turnover effect of inventory, you can get the quick ratio. And then finally, there's the cash ratio. Some people focus a little bit more on that. But I tend to see more, and I think you do too, tend to see more reference to the current ratio and the quick ratio than you do the cash ratio. But the cash ratio is nothing other than an indication of how much access to cash do you have really on your books right now in order to be able to pay, what's upcoming and what's due at the current liabilities. And that's just the idea. All of these ratios now. You should always remember when we think about ratios, right, you cannot look at the number in isolation. You can't say current ratio of 4 is good. Well, because, for the past 10 years it's been running at 18. Well, I know that's a kind of extreme example, but the idea is that, if you've been running at 2.5 for the past decade and now you're only at 0.8, the idea of the 0.8, you can't figure out whether that's good or bad unless you make a comparison. So there is a longitudinal time series type of comparison where you have to compare how the firm has been behaving in these metrics over time, or alternatively the cross-sectional type of analysis as to what the quick ratio of your firm looks like compared to the other firms in the industry. So you always have to make a comparison. You just cannot look at the numbers at 3, 2, 1.5, 0.7 and indicate that that's good. There has to be some kind of comparison, all right? So some additional ratios that are indicative in liquidity. We've got a couple of slides on this right now. I think important for you to understand is the issue associated with turnover. The previous slide, we talked about if you think about what was going on the previous slide, these liquidity ratios. Really, I mean, these are what? These are balance sheet items, right? And then here we've got some balance sheet items, but we're mixing them. Okay, we're mixing them with what? We're mixing them with some income statement items, right? So when we think about receivables turnover, right, as an example, right, when we think about receivables turnover, what you would, I guess the easiest way to think about receivables turnover, we have sales when we make a credit sale, right? And so we're providing liquidity to our customers by doing that, right? Well, ultimately we want to get paid. They ultimately want to get paid on that. So essentially, this receivables turnover is an indication, okay, is an indication of how long it takes really to generate $1 of sales from $1 of receivables. If you want to, I mean, the easiest way to think about it, even though the definition is annual sales divided by average receivables, because it's over the entire time period of the year. It's over the time period of the year. It just kind of gives you an indication of, if we're generating lots of sales, okay, and our average receivables are low, it means we're getting money in a whole lot quicker, okay? We're getting money in a whole lot quicker because our receivables, the lower our receivables relative to our sales, the more cash that we're getting, right? The more cash that we're getting maybe on a timely basis, maybe not, but that's the idea. Okay, inventory turn, all right? Inventory turn is a similar type of liquidity indicator, metric, and at the standpoint, it's indicative of what? It's indicative of how long really does it take to turn over our inventory. Because when you think about it, yeah, you might have lots of inventory, and it's great inventory, all right? It's great inventory, but unless you sell that stuff and get it off, and we can at the moment, let's not worry too much about how we're accounting for the inventory life of life or any of that other stuff. We're gonna just use cost of goods sold associated with an indication, indication of how much of that inventory we're getting out divided by average inventory. So from that perspective, what we'd like to be able to see, as another indication that, wow, you know what, we can get our inventory out a whole lot faster. So we'd like to be able to see a higher number there. Payables turnover. Well, payables turnover is essentially, I look at payables turnover as essentially being a mirror image of receivables turnover, except from the standpoint of us paying, except for a standpoint of us paying. So our receivables turnover, the faster we're able to turn over our receivables into sales, and our payables turnover, the faster we pay our payables relative to what we're purchasing. Essentially, that's kind of like the mirror image concept that we're having. All right, the mirror image concept we're having. Again, I indicated previously, some people say that they want to be able to stretch their payables, right? Well, that's a benefit, right? That's a benefit because you might be effectively managing your cash. We're going to get more into this a little bit later here, but might effectively manage your cash. But the longer your payables aren't being paid, the more difficult it is, or maybe possibly the more difficult it is to have good relationships with your supplier. So that particular ratio. Okay, that particular ratio again should be evaluated. All of these ratios, not that particular one, all of these ratios should be evaluated specifically from a working capital management perspective, from a longitudinal, or if you want to think of a time series perspective. And that the idea is that we're just really trying to see whether or not we are. It's taking us longer to get paid, or our inventory is sitting around too quickly, or it's improving, getting out of the door, etc. Again, looking at these ratios from a standalone basis is not what you should be doing. You should be making comparison over time. All right. So whenever I made a mention on the previous slide about receivables turnover and payables turnover, it's not indicative specifically, okay, on the amount of time measured in number of days. Okay, in order to get that measure, i.e., specifically a time period perspective associated with our receivables turnover and our payables turnover, we need to use number of days receivable okay, number of days inventory, and number of days payable, which is nothing other than taking 365 and dividing it by our receivables turnover, our inventory turnover, and our payables turnover. Okay. So our receivables turnover specifically does not give us an indication of the number of days. Okay, it doesn't give you an indication of the number of days. It just gives you an indication of of the ratio of sales to receivables, and we'd like to have that number. Okay, we'd like to have that number as high as possible, right? Because the numerator is sales and the denominator is receivables. So that it seems like we get paid more quickly. Well, specifically to get to the specific indication of a measure of when we get paid, we need to read the number of days of receivables, which in the numerator is 365, and the receivables turnovers in the denominator. Same idea with number of days of inventory, number of days of payable. All right. So from that aspect, what we'd like to be able to do is we want to. It's an indication of being able to do what? It's an indication. Okay, the number of days receivable, the shorter that number is, the greater the access to liquidity we have, right? So that's kind of the idea. Now, inventory, same idea, all right? Inventory, same idea. When we talk about inventory, we'd like to be able to turn our inventory more quickly, right? So that it doesn't sit. Okay, we just don't want it sitting in the warehouse, because when it sits in the warehouse, we got to pay for storage, we got to pay for all this other kind of stuff. We're just not earning on it. So we want to be able to get access to the liquidity on our inventory quicker rather than slower, or maybe I should say faster, rather than slower. Okay, so when we think about this, from the whole concept of managing our working capital. There's a couple of measures that come up, and I'm going to flip to and fro. The operating cycle, cash conversion cycle, and this net operating cycle. The definition is here on this particular slide. Okay, definition is here on this particular slide. But the actual, or if you want to think of it, not actual, but a graphic of those definitions. A graphic of those definitions are on the following slide. So I'm just going to go back and forth between the two so that you can see. Okay, I'm just going to go back and forth between so you can see. When we think about operating cycle, all right, when we think about the operating cycle is if you want to contemplate that, what does that mean? Days of inventory. Think of how many days it takes you to get your inventory out of the door, and then the receivables days or days of receivables. Okay, how long it takes you to get paid once your inventory gets out of the door. So when you put those two together, which is essentially what you see on the next slide, okay, since you see what on the next slide here, really what we're talking about is inventory and then receivables, right? And we add those two together. Okay, we add those two together. Let me see if I can do a better thing than that. All right, we add those two items together. That's essentially what we call the operating cycle. And the operating cycle. Well, the operating cycle, and you can put whatever numbers you want. I mean, okay, you can put whatever numbers you want. So you can kind of think of this as being, like, and I'll just put an example. Let's just say that's 40, and then let's say that's 30. So the operating cycle happens to be 70 days. Okay, the operating cycle has to be 7 days. Well, the operating cycle, not cyclical, operating cycle, can be used to help determine what we call the cash conversion cycle, i.e., if you really want to think about it, okay, is really how long is it going to take us to get our cash, okay, how long does it take to get our cash? And that's essentially, and how long does, not only how long does it take to get our cash, but how long do we get to hold on to cash before we pay our payables, all right? That's the reason why the cash conversion cycle is essentially, if you want to think of it this way, days of inventory plus days of receivable. Now, these two items right here, okay, are, really when we think about what? That's the operating cycle. But when we subtract the number of days payable, okay, that essentially kind of indicates how long we're going to be able to have access to the cash. It's also called the net operating cycle, but the idea, okay, that I just did here, let's just say, let's say that we've got 40 days inventory on hand, and it takes us on average 30 days to get our receivables, and these are just numbers I've just made up, right? Okay, these numbers are just made up. Okay, essentially, let's just say that our payables days happens to also be 40, and I know it doesn't look right, with the lengths of the arrows, but don't think of it that much. Which means our cash conversion cycle, okay, is going to be 30 days. Okay, it's going to be 30 days. Think of this, okay? Think of this as, that's how many days we have to kind of finance, right? We have to finance because of the standpoint, that what we were doing, okay, what we're doing here is that we have our inventory, we turn it over, we make a sale, we get paid, and then we make a payment. Well, there's a gap between us paying and making payments, and that's essentially the cash conversion cycle, and that's really just the idea. That's really just the idea of what we're talking about. Now, some people would say, well, what we'd like to be able to do, okay, is make that cash conversion cycle as long or as short as possible. Well, that's just kind of the idea. Remember, there's always that trade-off. Okay, there's always that trade-off. It's always better to get paid quickly. Okay, it's always better to get paid quickly. So you'd like to be able to. You'd like to be able to shorten that conversion cycle as best as possible. But, again, these are metrics. Okay, these are metrics, and they have to be used I would say, evaluated from a comparison purpose. You just cannot make any specific determination as to whether things are good or bad just by looking at 40, 30, 20, 50. Unless you make a comparison to either A, over time for the particular firm, or B, its peer group out there in the marketplace. All right. So what happens? What happens whenever we're talking about, man? You know what? I need access to cash. Okay? I need access to cash. Well, why do you need access to cash? Well, I got to pay a bill tomorrow. That's the whole idea, right? I mean, when we're talking about cash, really what we're talking about is, I think the vast majority of us individuals would indicate that having more cash in our pocket is preferred to less cash in our pocket. True. The problem is that the firm, cash sitting there, really is not being put to use from an overall operation perspective. Now, that doesn't mean then it can't help the firm reach and attain its goals. And that's kind of the idea of what working capital management, about managing that daily cash that you have around, is all about. So what you should think of, is that you should be, again, there's always that trade-off, right? You need to have enough cash around for routine needs, all right, but not so much. Not so much that you're going to forego interest income because it's just sitting there. It's just sitting there and it's not being invested. I mean, cash is cash, all right? And, depending on the economic environment, a lot of people say, well, you need more cash because things are bad. Well, you don't need as much cash because things are good. You want to put it to work. Well, everybody and every manager always has a different kind of risk aversion to the economic environment, right? Bottom line, though, is that if you keep cash in your pocket, or if you keep cash in your checking account, and you keep cash, underneath your mattress, and you say to yourself, well, John, firms don't do that. Well, you know what? Over time, the cash balances of firms get pretty large, right? They get pretty large, and then they go down and get pretty large again. Technically, when you think about cash, and not a cash equivalents, I'm not talking about short-term treasuries or any cash-like instrument that is paying some kind of interest income. But may have to be tied up a little bit longer. I'm just talking about just cash. All right? I'm just talking about just cash. It's not really earning anything. Okay, it's not really earning anything. So the idea, this sounds simpler than it really is in reality. The idea is to try and do what? It's to try and balance. Okay, I need enough cash to be able to make sure that I pay my light bill in a week. I need enough cash to make sure I'll be able to pay my employees in 2 weeks. I need enough cash around because in 7 days I'm going to have a quarterly tax payment that I have to pay, something on that order. It's good to be able to have that amount of cash sitting around and not doing anything. But you don't want to have too much of it sitting around and not doing anything because you're not earning anything on it. All right? Okay, so how do you do that? Well, That's all about what? Forecast, right? Whenever you make a forecast, what do we know about a forecast? Well, a forecast is something that we know is uncertain. Well, we can. That's true. It's always uncertain, right? I mean, because if it if it were known for certain, it wouldn't be a forecast, right? Because we would know what the number is. But you can make informed estimates of how much cash you really need to be sitting around based on sales, when you get paid, when you're going to make payments, purchases, collections and purchases, when wages are due. I mean, wages are pretty much due on a calendar cycle, right? Every week, every 2 weeks, every beginning of every month, something on that order, right? So you have an ability, okay? You have an ability to do what? You have an ability to see cash coming in, okay? Cash coming in, and then you have an ability to see cash coming out. Agreed, it's not always 100% certain because it's a forecast and you might not receive all that cash you thought coming in, and then you made to make a decision not to make those payments that you thought were going to go out. Bottom line, you can make what? You can make an estimate as to how much cash you need to be sitting around. And that those forecasts, okay, those forecasts are probably going to be of higher quality the shorter the term. And in the longer term, the more estimates come into play. So there are various horizons, and I indicated to you when we're talking about working capital management. Okay, we're talking about working capital management. Generally, the idea is to kind of think of short term, but from a forecast perspective, short term and medium term, from a managing cash perspective, is really over the next couple of weeks to the next month. To the next year. And then once we go beyond that, okay, the long term, really, that's not an issue associated with working capital management. Really, we're going to be focused on our net daily cash from a working capital management perspective, really on the next couple of weeks and then within the year, because that's really the idea. If you just keep in mind those two ideas that I indicated to you, liquidity and short-term horizon, all right, that kind of gives you an idea as to the length of forecast, the length of time of forecast that you would be making, length of time of forecast that you make. So let's suppose that we have enough cash coming in. We make some forecasts. Okay, we make some forecasts. And it looks like we're going to have more cash than what we're going to need in the near term, the intermediate term, and possibly for the next 6 to 9, 12 months. What do we do with that extra cash, that excess cash? And what I mean by we make these forecasts that we have extra cash that we don't need, I mean, we go ahead and we take care of all of our expenses, we take care of all of our capital expenditures, we take care of all of that stuff, and all of a sudden, wow, we've got some excess cash. Okay, we got some excess cash. Some people would call that free cash flow, but I'm not really. We're not going to go to that particular definition just yet. We're just talking about the standpoint. We have a forecast of cash coming in, okay, and then we have a forecast of cash going out. All right. What we see is that the forecast of cash coming in is bigger than the cash going out. And what we'd like to be able to do is what to do with that excess. Right? What to do with that excess. All kinds of different things we can do with it. All right? We can invest it, okay, specifically in short-term, high-quality short-term securities. High-quality short-term securities. Now, we didn't put that down on the slide. All right? Invest excess cash in short-term securities. We should also be thinking excess cash in high-quality short-term securities because we want to be able to make sure, if it's cash-like, that means what? Whenever we want to go get it, it's going to be cash, and its value of $1 is going to be worth $1, not 75 cents. So we want that quality to be there, right? So what are the instruments that we use? I mean, there's just a myriad of vehicles of which you could place excess cash. Treasury bills, short-term federal agency securities, bank certificates of deposit, bankers' acceptance, time deposit, repurchase agreements, commercial paper. A lot of people, I think, a lot of people kind of forget about the standpoint that not only do firms issue commercial paper, i.e., they get liquidity they raise liquidity by doing what? Issuing commercial paper. But firms can also do what? They can also invest in commercial paper, i.e., it's very short term. It's very short term, but it's high quality paper, in which the odds of being repaid are high. So I don't think it's necessary for you to know all of the characteristics of all of the short-term investment vehicles that are available for a firm. just recognize, just recognize that whichever vehicle you choose to invest your excess cash, and whichever vehicle you choose to invest your excess cash, essentially, what are you hoping to be able to get from that? You're hoping to be able to get some earnings, some income, some interest, and you say to yourself, well, wait a minute, I've already done the forecast. I've got money coming in, I've got money coming in, I've got money going out. Now, so what that means is that I've got 2 chunks of money coming in that I need to do something with. Well, when you do something with that 2 chunks of money coming in, guess what? You get to earn something on it. So the idea is that you don't want it just sitting there in cash in a checking account. Okay, and I'm just going to make a blank supposition that checking account's not going to pay you any interest. Let's just forget about the standpoint that they might, but they just say none. Well, what we want to be able to do is to take that, all right, from the checking account and put into treasury bills. We want to be able to put it into a CD. We want to be able to invest in a commercial paper for the next week, etc. Whatever the case is that we want to be able to use. The whole idea is that we are trying to earn something on that excess cash, not let it just sit there as cash. Unearning. Okay, unearning. Think of the idea as that we are attempting to do what? We are attempting to, and we're attempting to take, and we're attempting to try and generate as much benefit for the firm as possible. And excess cash is essentially when it just sits there, it just doesn't benefit the firm. Yeah, sure, you can always get access to it, that's right, but you can always get access to treasury bills also, and it pays a little bit. Depending on the time horizon, it might be really, really small, okay, but it's going to be there, right? Okay, it's going to be there, right? So when we talk about these instruments, right, when we talk about these instruments, and when we talk really about working capital, and especially cash, reinvesting excess cash, really we're talking about in the broader terms of investing in what we call the money market, investing in the money market. And on this particular slide here, we're talking about short-term yields, and what I mean by short-term yields, I'm talking about yields or return metrics of return on short-term instruments, and measure of returns on short-term instruments. And one of the ideas that I think you should recognize is that many of these instruments, many of these money market instruments, generally speaking, essentially trade at what we call a discount. And what we mean by that is that you invest $960 and you'll get back $1,000, something like that. So their price is less than the face. So the idea I think we should recognize here is when we think about this concept of a discount, all right, the price that you pay is going to be less than the face value that you're going to receive later. So that's the idea when we talk about a discount, trading at a discount. It's trading at a discount to its value that you're going to receive later. Okay, and in nomenclature terms, that value that you're going to receive later is what we call the face value. It's also referenced as being the principal value. It's also referenced, generally speaking, as being the par value, etc., etc. So don't worry too much about that right now. Just think of this as being something on the order of, okay, the face value is $1,000, okay, and the current price is $980, okay, and and that the face value is $1,000, all right, and the face value is $1,000. So that's kind of the idea, all right. That's the idea. The percent discount is essentially what you paid relative to what you're going to receive. Now, the problem with that is that it really isn't. If you think about it, okay, when you think about it, it really isn't a return measure per se. And a return measure per se, because why? What's in the denominator? Okay, what's in the denominator? And that happens to be what? That happens to be the face value, right? It happens to be the face value. So this percent discount right here, okay, in the denominator, it's not what you paying, it's what you're going to be receiving. It's really just the difference in what you paid and what you're going to be receiving, i.e. that change in value relative to the value that you're going to receive. Is essentially what is going to be that percentage discount. Now, when we multiply that, by this 360 divided by days, that's a simple annualization, okay, a simple annualization of that discount, because that instrument, okay, that discount instrument of what you're going to be investing in, Okay, maybe a 90-day instrument, it may be a 60-day instrument, maybe a 180-day instrument, maybe a 30-day instrument, whatever the case. But essentially what we want to be able to do is we want to be able to take that discount and essentially gross it up on an annualized basis. Now this is called simple annualization, okay, because of the standpoint that we all know that every year has what? It has 365 days. But it's just left over from a historical perspective that way back when in the old days, before electronics and before calculators and before the internet and before the web and etc., it was just easier to do calculations different types of ways. Okay, so this bank discount yield, all right, this bank discount yield, I think what you should recognize, okay, is nothing other than, it's not your truly effective, okay, rate of return, all right, but it's just more of a simple annualization, okay, a simple annualization of the percentage of the discount that you're going to get, i.e. how much you could gross up if you held that instrument over the year. And generally speaking, you're going to hold it for that time period, but you only hold it for that time period. You don't hold it for the year, right? So think of it as being a simple annualization of a periodic number, okay? And that periodic number is that percentage discount held over that period of the instrument, and then you just gross it up to, from an annualization perspective, over the number of days that you've held it. Which then brings us to the idea associated, and I'm going to try to stay with the same numbers here, and I'm not going to do the calculations. I mean, feel free to do them on your own here. I'm just trying to get you to see, okay, essentially what kind of impacts we're having here. When we talk about the money market yield, though, so this is the bank discount yield, all right, this is the bank discount yield. The money market yield, on the other hand, look at this. This is not the percentage discount, okay, this is not the percentage discount. It is the what? The ending value minus how much you pay divided by how much you pay. Well, think of this. When we talk about return, okay, in the simplest of definitions, ending minus beginning, okay, divided by beginning, right, is essentially what we call a holding period return. Well, we're just calling that a holding period yield. Well, on this instrument, because it's a money market instrument, okay, i.e. it's going to be an instrument that has a life of less than a year, all right? This piece right here, this ending minus beginning, is essentially equivalent to the face minus the price divided by the price, because in the denominator is what you paid, and in the numerator is the quote-unquote value change you're going to receive. But it's not relative to the value that you're going to receive, it's relative to how much you paid. Okay? It's relative to how much you pay. So if we keep our example here, this happens to be 1,000. Okay, this happens to be, well, let me make sure we're going to use the same number, 980, okay, and then this happens to be also 980, right? So the idea is you can see the difference, okay, you can see the difference in that when we're talking about a discount, we're talking about a discount relative to what? The value that you're going to get. But when we're talking about a holding period return or holding period yield, it's the what? It's the change in the value relative to how much you paid, okay, relative to how much you paid. So that money market yield, okay, uses this holding period concept, okay, But then look at this. This is nothing other than a what? A simple annualization, okay, of that quote unquote periodic return that you received, So that money market yield is slightly different than the bank discount yield because the standpoint is that it uses HPY, or the holding period, i.e. the change in value relative to how much you paid, relative to the bank discount yield, which is the change in value relative to how much you're going to receive. But they're both simply annualizations from the standpoint that we're just using 360 divided by the number of days that you held the instrument. And then finally, there's this concept of a bond equivalent yield. Now, I think we need to kind of clarify some stuff, because in other segments of the material, you will see this bond equivalent yield, and this bond equivalent yield is mainly connected to returns on bonds. And what we are attempting to do here, is essentially to take this holding period return, or this holding period yield, i.e. the return that we get over the time period that we hold this money market instrument, i.e. and annualize it in quote-unquote effective terms, i.e. to 365 days. This particular number is not to be confused with that bond number that you're going to get in the fixed income segments of the material that you're going to run across. Okay, because that number is 2 times the effective semi-annual rate. All right, don't confuse those two. Essentially, what we are attempting to do, is we're essentially attempting to annualize, not simply annualization, but annualize an effective aspect, because we're going to use 365 days, the holding period yield. Okay, the holding period yield. So from that aspect, I think it's just an idea. Well, it's not an idea. This is important material for you to understand from a working capital management perspective, in that we're focused in the short term, and in the short term we have excess cash that we can invest. And when we invest that excess cash, we're probably going to be putting it in a discount instrument. And that discount instrument, we can get a return, a bank discount yield, a money market yield, and then what we'd like to be able to do is to compare it to other instruments, okay, on an annualization effective type basis, this bond equivalent metric. All right, and that's the idea. That's the idea that I want you to. That's the big takeaway that I want you to have. A big takeaway I want you to have there. All right. All right. So we talked about investing the excess cash, but how did we do that? Yeah, how do we do that? Well, the idea, okay, is that you should always have an investment policy statement, okay, which is a formalized document that says who, what, when, where, how you're going to make your investment, okay? And what we're talking about here, when we're talking about cash management investment policy statement, essentially this is a formalization of the policies and procedures that you're going to follow when you have what? Excess cash on hand to do what? To invest in those treasury bills, those commercial paper instruments, etc. Okay, and the purpose and objective of that investment policy statement, you know, as an example, I mean, now again, these investment policy statements are going to be unique to the firm. So since they are unique to the firm, all right, every firm can have a different investment policy statement. Right? So, but the idea is that generally is what? There's a purpose and objective of our investment portfolio, cash investment portfolio, which is to do what? To invest and earn a rate of return commensurate with the risk that we're going to be investing our cash. And generally speaking, that's going to mean what? When you're talking about investing cash and you want to still get a cash asset available to you, I mean, that's going to be, generally speaking, going to be a lower level of risk. All right, so that purpose and objective statement is going to be in the investment policy statement. But so, you know, the strategy guidelines, the types of securities, I mean, these are all going to be specific. You know, who's responsible, you know, what happens if there's a problem, the corrective steps and limitations, you know, what not to do, etc. So it really all goes back down to, I think this is really important, who, the individuals, what kind of securities, when, what are we going to do with it, what determines that we're going to be making some of these investments, i.e. what's the definition of excess cash, how long do we have for it, etc. So when we think about this cash, and when we think about this investment policy statement, it's just nothing other, okay? It's just nothing other than a formalized document that provides a policies and procedures of what to do, with your excess cash. All right. Well, this. These next two slides kind of move away from cash, or I guess take the next step away from cash, but yet still are in working capital management, right? Because when we talk about working capital, that's current assets minus current liabilities, and you know, in our current assets, we have what? We have accounts receivable, right? We make a sale, we don't get paid. Hey, we don't get paid, but it's like providing trade credit for our our customers. Right, so it's kind of like you're doing a credit analysis whenever you provide trade credit for your customers. Right? So what tends to turn out, or what we tend to generate whenever we have one of these, whenever we have this business, i.e. a business that we don't receive cash every time we do a transaction, we have an accounts receivable, and accounts receivable is also amenable to what we call an aging schedule, which is nothing other than this. It just indicates, okay, how much do people owe us that has been outstanding for less than 31, how much people owe us has been outstanding between 31 and 60 days, between 61 and 90, and then greater than 90 days. That's all it is. Now, some people will say that this is kind of a demarcation when you have to start getting worried. Once you get beyond 60 days, you should be a little careful, and you should be calling up these people. You should be calling up those people who owe you that number, right? Now, what you should recognize, is that generally speaking, this is not always going to be the case, but generally speaking, we have a what? We should have a lower, our schedule, our aging, okay? Our aging should indicate a lower outstanding balance the farther we go. Otherwise, otherwise we've turned into a long-term lender. We don't want to do that. Okay, we don't want to do that. And also, too, the farther we get beyond 90 days, okay, the farther we get beyond 90 days, I mean, the probability of collecting on that sale, on that transaction, gets lower and lower and lower. All right. So an aging schedule is nothing other than representing the dollar amount of accounts receivable that's outstanding, okay, that hasn't been paid yet within these buckets of time. Less than 31 days, 31 to 60, 61 to 90, and greater than 90. And that's all it is, right? I mean, a lot of people try to read a lot into that, but that's all it is. The best, I think what you should recognize, okay, is that you can use this aging schedule to get you a kind of a two-dimensional look of the firm, all right, two-dimensional look of the firm. One of the ideas is that if you see in the 61 to 90 days column, and now this is in a kind of a reverse chronological order, or some people say this is in chronological order, March, April, and May, meaning May is now. Let's just say that. Okay, if you see the 61 to 90 days aging increasing over time, then there might be an investigation. Might have to have an investigation of what's going on. Okay, might have to have an investigation of what's happening. Why is that number increasing? Well, in this one, it's pretty much it's relatively staying the same, and so is the greater than 90. It looked like it's increasing a little bit, right, from 50 to 70 to 66. But you know, depending upon what what that number is in relation to your total receivables, which is one of the reasons why some people like to see this aging schedule as represented as a percentage value as opposed to percentage of outstanding receivables, as opposed to a numeric or absolute number. Yeah, sure, it's nice to see we have $200,000 outstanding, but really, what does that mean from an overall $195,000? I mean, do we have $1 million outstanding, or we only have 250,000 outstanding? So that's kind of the idea, which is one of the reasons why some people like to see an aging schedule represented in percentage terms as opposed to in absolute value. Okay, absolute value. Now, another one, and we're not going to be able to know how we've gotten these numbers, and you don't need to worry about that here. But when we see, what we see here is that the percentage weight, all right, within each quote-unquote aging bucket, and I know it's a highly technical term. Some people call it a time break. I just call it an aging bucket because of the standpoint I'm just dumping everything in the less than 31 days, dumping everything in between 31 and 60 days. How long does it take to collect? Well, there's 22 days on average. I get my accounts receivables paid, 44 days on average for those receivables that turn in or fall or slide into the bucket 31 to 60, 74 days between 61 and 90, and 135 days greater than 90. Okay, so what does this mean? Okay, I think there's an easy way to think of it. And again, we don't need to worry about how we collect and how we're getting that data. There's just some numbers that are going to be provided. And essentially what we are attempting to do is that ultimately when we decide to make a sale on credit, i.e. To have an accounts receivable, what is it that how long should we expect on average to get paid? All right, and that's what this weighted average collection period concept is getting at. All right. So what this means is that on average, all right, if I don't pay a bill within the 31-day bucket, okay, on average it takes me. Let me phrase that. If I don't get paid, not if I don't pay, we can do the same thing with payables, but let's just not get there. If I don't receive payment from a customer within 31 days, all right, and if they tend to pay before the end of 60, on average it takes them 44 days to pay. If they don't pay during that time period, on average, it takes them 74 days to pay. And if they don't pay in that time period, on average, it takes them 135 days to pay. And then we can multiply each one of those, okay, each one of those average collection days for each one of the time horizon buckets, and the aging buckets, multiplied by the weight, and the weight is the outstanding, is the amount of receivables outstanding of a total. That essentially gives us a weighted days period, and that's all it is. So if we go back to the idea of weighted average collection period, it says when I make a sale, on average, I should think about the idea that I'm going to be paid within 50 days. Okay, on average. Now, again, what does that mean? Some people pay you in 2 days, some people pay you in 165 days. So it's not like, it's an indicator, it's just an averaging concept. And so it's not going to be, okay, it's not going to be indicative, fully indicative of when you're going to get paid. It's just an averaging concept. But an aging schedule can help you understand that. And and you say to yourself, well, why do I want to have that? Well, if you kind of go back to formulating what? Forecast of money coming in. All right, well, we can use an aging schedule to get an indication is that when we make a sale, we're going to get a piece of that paid within 20 days, 31 days, we're going to get a piece of that paid within 90 days, etc. And then that way you can forecast how much cash you got coming in based on how many sales you expect to make. Okay? Based on how many sales you expect to make. All right? So here's the idea, and I mentioned this on the first or second slide. I can't remember exactly which one it was. Okay. But when we talk about working capital management, it really is an issue associated with what? It's an issue associated with a trade-off between, when we get the money in, we got the money, now I got to pay it out. There's all kinds of different reasons why you want to delay payments or why you might want to take advantage of paying early. But let's just not get into that, right? What you should recognize is that it's a what? It's a trade-off, right? Well, each and every one of those, on the money coming in and the money going out, are all trade-offs. When we talk about working capital management, we're talking about what? Managing current assets and current liabilities. It's all about what? It's all about CA minus CL, okay? And that's the focus, right? That's the focus. So when we talk about operations, and that's why it's working capital, i.e. operations, right? Talking about receivables, we're talking about current assets, right? Well, current assets, receivables, right? I mean, what's an easy way? Okay, what's an easy way to really increase let me rephrase that. What's an easy way to really increase sales? Right? Anybody got any idea? Well, it's what? Sell to everybody, no matter what their ability to repay. I mean, you can just chalk up a substantial amount of growth rate in sales if you just sell to everybody and you sell them a lot of stuff. Right? And what's that going to mean? That means your accounts receivable numbers are going to go up, right? But you'll never get paid. Well, then, by definition, that's not really doing good. So there's always that tension between establishing credit or granting credit to get a sale, relative to the standpoint that you don't want to, be too loose. You don't want to be too restrictive, otherwise you won't get any sales, but you don't want to be too loose on your credit terms, otherwise your sales numbers are just not going to be able to be collected. Inventory is the same way, okay? If you you want to make sure that you have a very, just-in-time inventory, that's kind of like a relatively, I'd say over the past decade or so, topic about inventory management. Just-in-time management is really good, right? You've got the raw materials coming in, you got everything making, and boom, it goes out on the shelf, get ready to be delivered to the customers, right? And it's only done once you get the sale, or something like that, right? Well, the problem is that what happens if you have a delay in one of your inputs of raw materials? Well, all that means is that the problem right there. Okay, you've got a problem that you have to deal with, right? You don't have enough. You don't have the inventory, right? Your inventory level is so low. There's no cushion. Okay, there's no cushion. And so if your inventory is too low, you'll have a stock out and won't be able to have a good relationship with your customers, won't be able to make a sale. On the flip side, if your inventories are too high and it's just sitting there for 6 to 9 months before it moves, you're going to be increasing carrying costs, etc. So it's all, again, we talk about working capital management. It's all about a trade-off, right? You want to have enough inventory to be able to make sure you get the sale, but you don't want to have too much because of the extra costs that are incurred with it sitting there. And then finally, this payables issue on this particular slide. is that, again, there's all kinds of different reasons why you might want to take advantage of early pay, or might want to just let it, extend out. I.e., the more you have it extend out, the cash, the more you can earn on it with interest. There are some benefits. Sometimes you'll see an invoice that comes in that says 210 net 30, which means essentially you get to take a 2% discount of the value. So let's just say the invoice has a value of 100. Well, if you pay within 10 days, you really only need to pay $98. You get to take a 2% discount. All right. And then if you don't pay within those 10 days, you have to pay the entire 100. So that's fine. So you can pay early to take that discount. But if you don't pay early, and what's really the disadvantage of just paying not in 30 days, but in 45 days and 60 days, unless there's some kind of penalty associated with that. And a lot of people would like to do what? They'd like to be able to stretch that out as long as possible. But the problem is that the longer you get stretched out, the longer the payment gets stretched out, stretched out, okay, the more your supplier is going to get a little bit upset. I mean, the relationship issue, they did this. They gave on good faith that you were going to pay within reasonable terms of your agreement. And if you keep on stretching out, you get to do what? You get to earn by investing that money and not paying them. But on the flip side, you get to earn investing that money, but you're really, you're really causing your relationship for that supplier, especially if they're a good supplier, really causing that relationship to be problematic. Or really, ultimately, they could help you one day, and then whenever you really need them, they won't be there for you. So when we talk about working capital management, this whole issue of current assets, current liabilities, it's always a trade-off. There is no one particular, there's no one particular way, reason. There's no one particular path that you should take. You should always be thinking of it in terms of a trade-off. If I want some sales, I can go ahead and grant more credit. But if I grant more credit, I have to realize that I might not get paid. My inventory, I really want to keep low, but I have to realize that I might get a stock out. I don't have enough inventory. I mean, it's kind of frustrating, right? Whenever you go somewhere, you want to buy something, and you really need it, and they're like, well, I'm sorry, but we don't have any more of those. Well, that's the issue associated with that. It's always that trade-off, right? It's always that trade-off. Right? So we talked a little bit about, and maybe this issue should have been in another section of the material, but that doesn't matter. We talked a little bit about sources or I guess outlets for investing short-term or excess cash. The slide about short-term investments that talked about treasury bills and short-term securities, repurchases, commercial papers, etc. Well, that's whenever you have excess cash, you invest in those instruments. But what happens whenever you need some short-term funding? Okay, you need some short-term funding. Well, we talked about lines of credit already. Okay, we talked about lines of credit already. And when we talk about lines of credit, we can kind of break them out into, I guess, two big components: a committed amount and an uncommitted amount. The committed amount says, the bank says that, okay, you can borrow up to $1 million within a 6-month time period. But you're going to have to pay a fee for that. And what that means is that they will loan you up to $1 million. Or there might be an uncommitted line of credit that says, well, you know what? We think that you're worth borrowing up to $1 million over any certain time period. You don't need to pay us a fee, but whenever you come to us to borrow that money, things might have changed, and we don't think that you're worth that. So it's uncommitted in the standpoint that is that whenever your customer may need it, it might not necessarily be available, but they don't have to pay a fee for it either. Okay, they don't have to pay a fee for it either. All right. We talked a little bit about some banks acceptances, factoring. Essentially. We have factoring is nothing other than this concept of, in the current assets you've got accounts receivable. Let's just suppose let's just say your accounts receivable has a number of 100 attached to it. Well, essentially what you want to turn that 100 into cash now. Well, factoring is nothing other than you don't want to have to deal with collecting that money. What you're going to do is you're going to sell those accounts receivable to a third party, and they're going to go and do the collection for you. What they're going to do when they buy your receivables, okay, what they're going to do is that they're only going to pay you 60 cents, 75 cents on a dollar, whatever the case is. So there's a lot of fees associated with it. And The main users from a working capital management perspective of factoring is you've got smaller shops that they really don't have the time to go out and run down and collect money from their customers. They'll let people who have a little bit more expertise, in that business, take care of that for you. Commercial paper, which is kind of like on the opposite side of the factoring aspect, is that what we'll do here is that we'll issue some short-term loan. Okay, we'll issue some short-term loan, and then to be repaid back in the next 5 to 7 days, etc., whatever the case is. All right. So just like when we talked about places to invest short-term investing in cash, excess cash, and short-term investing vehicles, there's also a pretty heterogeneous amount of short-term funding sources that you can use at the commercial level to manage your working capital. Right. So here's we're going to kind of go back, take a step back a little bit. This will be the last slide in this segment. Problem associated with cash management. Let's suppose two firms, Firm A and Firm B. Firm A's operating cycle is 38 days. Firm B's operating cycle is longer at 42 days, but its cash conversion cycle is shorter than that of Firm A. Okay, it's shorter than that of Firm A. What is it that we can conclude? Okay, what is it that we can conclude? So when we think about this, but its cash conversion cycle is shorter than that, okay, of Firm B. Okay, when we think about it, what's happening here? All right, we have, and I'm going to draw the 42 days here. All right, I'm going to draw the 42 days. All right, this is 42. All right. Firm B's operating cycle is longer than the 38, right? It's longer than the 38. But what? Its cash conversion cycle is shorter than that of Firm A. And let me see if we can move back just to this graph. And I just want to make sure we can get back there. Oh, there it is right there. All right. Yep, there we go. All right. So what we're essentially doing is that we are doing what? We're doing what? We're comparing 42. We're comparing 42 and 38, right? Of this length, right? Okay, it's 42 and 38, and that is what? That's essentially the the operating cycle, right? But what? But Firm B's cash conversion cycle, okay, cash conversion cycle is what? Is what? What did it say in the problem? Okay, what did it say in the problem? Let me get back over here. What did it say in the problem? It says cash B's cash conversion cycle is shorter than that of Firm A. So when we think about that cash conversion cycle, and let me make sure I can get back over here. Wait, hang on one second. There we go. Okay. Essentially, what does it mean if the cash conversion cycle is shorter than that of Firm A? Well, it has a longer operating cycle, but the cash conversion cycle is shorter. So that means its payable days must be longer, right? Got to be, because its operating cycle is longer, right? Its operating cycle is longer. So when we think about it, what is the answer? Okay, what is the answer that we should be thinking of? Firm B has a lower payables turnover or a higher payables turnover. Okay, I mean, because that when we think about that cash conversion cycle, really we are thinking about the difference between the operating cycle, and the operating cycle and the payable days. And because that really is, the cash conversion is the difference between the operating cycle and the payables, right? That's the difference, right? So when we think about that, really, answer C is the best answer there, because it's the one most closely related to the standpoint that Firm B has a longer payables days, okay, and which essentially means what? That they have a lower payables turnover. Okay, a lower payables turnover. So from that aspect, that's the answer. That's the answer there, and that should be It should be C. It should be C. All right. So with that in mind, these were in this segment of the video series. We just covered some basic working capital management topics, and which you can formulate and incorporate in your overall studies on corporate financial matters. And from that aspect, when we talk about working capital, we're really not talking about capital expenditures. Two things to keep in mind. We're talking about liquidity and short-term time horizon. If you can remember those, you can continue, you can formulate decent aspects and formulate decent ways to think about decent ways to think about appropriate and effective working capital management issues.